Hello everyone. Welcome to my house buying secrets channel.
In this video, I am going to talk about the second chapter of mortgage. In the first chapter, I talk about what is a mortgage. If you have not watched, I will leave the link in the end of this video. Let's find out the different types of mortgages available in the UK, and where you can get an access or approach. Before I explain further, please like, share and subscribe my channel and also click on the bell button, so that you will get a notification of my next video.
There are several main types of mortgages in the UK, each suited to different financial situations and risk preferences. First one is fixed rate mortgage. Your interest rate stays the same for a set period, commonly 2, 3, 5, or 10 years. What is the main advantages of taking this mortgage? Do you know? Well, the main advantages is predictable monthly payments, which means the monthly payment is the same for the entire fixed term. Another advantage is the protection from interest rates rise. For example, if the Bank of England increases the interest rate, you don't need to pay the higher amount. You just need to pay fixed amount which you usually pay. This is called fixed rate mortgage. Now, what is disadvantages of having this mortgage? Well, let me tell you. If the Bank of England reduces the interest rate, you won't get any benefit. If the rate falls, you still need to pay the same amount on your fixed rate. Another drawbacks of having fixed rate mortgage is, you need to pay a higher early repayment charges if you decide to break the term. The next type of mortgage is variable rate mortgage. What I mean by that? The interest rate can change over time. Common types include standard variable rate, SVR. The lender sets the rate and can change it at any time. Another type of mortgage is tracker mortgage. Has anyone heard of? Well, tracker mortgage, basically, it tracks the Bank of England base rate, plus a fixed percentage. For example, let's say the base rate is 4.5% and the tracker rate is 1%, then you need to pay 5.5%. Another type of mortgage is discount mortgage, which is not very common in UK, but it still exists. Common type of mortgage is repayment mortgage, which means you pay interest and part of the loan balance. At the end of the term, the mortgage should be fully paid off. This is the most common type mortgage in the UK, and this type of mortgage is beneficial for first-time buyers and people who need remortgaging the property. Another type of mortgage is interest-only mortgage, which means you only pay the interest each month. In this case, the original loan amount remains outstanding and must be repaid at the end of the term through investments, savings and property sale. This usually requires higher income, strong repayment plan, larger deposit, or equity release from the current property. The next common type is first-time buyer mortgage, which is designed for people buying their first home. This may include smaller deposits, usually 5 to 10%, and also you can get incentives or cash back if you take this kind of mortgage. The next common type of mortgage is buy-to-let mortgage. This is commonly for properties rented out to tenants. This usually need larger deposit required, often 25%, and it's based partly on expected rental income. Another common type is joint mortgage, which means 2 or more people apply together. This is commonly for couples, family members, friends who are buying together. Another type is guarantor mortgage, which means a family member guarantees repayments if you cannot pay. It's mainly useful for people who have low income, limited deposit, and poor credit history. Also, let you know there are government-linked and specialist mortgages. Shared ownership mortgage, which include you buy a share of a property and pay rent on the remaining share. Usually linked with housing associations. Help to Buy legacy scheme, a government-backed scheme that helped buyers with equity loans. Most schemes are now closed, but existing borrowers still have Help to Buy loans. There are offset mortgage available too, which means your savings are linked to the mortgage account to reduce interest charged. This is the overview of different type of mortgage. I hope you still enjoying this video. Now let's go into the topic. Who provide the mortgage? Well, major UK mortgage lenders include high street banks, building societies, specialist lenders and online lenders. There are banks commonly: Halifax Bank, Nationwide Bank, Barclays Bank, HSBC and Santander Bank. These are the common type of banks in UK. In the UK, building societies are member-owned financial institutions that offer savings accounts, mortgages, and sometimes current accounts. Unlike banks, they are owned by their customers rather than shareholders. They commonly provide mortgages for first-time buyers, home movers, remortgaging, buy-to-let, self-build or specialist lending. Some of the biggest UK building societies that offer mortgages include Nationwide Building Society, the UK's largest building society, offering a wide range of mortgage products. Yorkshire Building Society, Coventry Building Society, Skipton Building Society, Leeds Building Society. Halifax was originally a building society before becoming part of a bank group. Principality Building Society, Newcastle Building Society. Building societies are often known for competitive mortgage rates, more personalised underwriting, helping borrowers with unusual circumstances, strong customer service. They lend money in the same basic way banks do. You borrow against a property and repay monthly with interest over an agreed term. Now let's look into a specialist mortgage lender. They are the lenders that provides mortgages to people whose circumstances don't fit the criteria of mainstream banks and building societies. These lenders often help borrowers such as self-employed people with complex income, contractors or freelancers, people with poor or limited credit history, first-time buyers with unusual situations, older borrowers seeking mortgages later in life, buy-to-let investors with multiple properties, people with recent defaults, CCJs, or past bankruptcies. In the UK, examples of specialist mortgage lenders include Kensington Mortgages, Aldermore, Precise Mortgages, Pepper Money. The mortgage lender. Specialist lenders usually assess applications individually rather than relying solely on automated scoring. May accept borrowers who have been declined by high street lenders. Often charge higher interest rates because they take on more risk. May require larger deposits depending on the situation. Example: if someone is employed full-time with a stable salary and excellent credit, a mainstream lender such as Nationwide Building Society or HSBC UK may offer the best rates. If someone is self-employed with only 1 year's accounts, or had missed payments 2 years ago, a specialist lender may be more willing to approve the mortgage. The next type is online lenders. They are the lenders who operate mainly through the internet rather than the physical bank branches. You can usually apply, upload documents, receive decisions and manage your mortgage.
Thank you for watching this video. Please like, share and subscribe my channel. I see you in the next video.